And now for something completely different.
It's a Rick Bass world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to, it's the and we've said this before, right? But for all of our new listeners at Talk 1370 in Austin, welcome to the show, of course. New week for you guys. And you will now learn that today is the second best day of the week. It's the day before Friday. So welcome to the Thursday show.
Yeah.
I'm your host, Lance Roberts. Brett Clinton joined us this morning as well. Coming up on the show here in a few minutes, we'll have Michael Lebowitz, CFA. We're going to talk a little bit about the election, the outcome, the markets. And I've got a few things for you this morning to discuss with you, particularly about why the outcome of the election is really not as bad as you think. And we're gonna talk about this in particular. But first, let's get to the markets yesterday. Markets had a boomer day yesterday, and a couple of things happened technically that are important for stocks in particular, which was one that we actually did finally turn that money flow buy signal back to positive. And this is something that we've been talking about here, very close to also triggering a buy signal in terms of our moving averages as well. Very close to turning both of those back positive. The money flow signal is positive again. Now, that doesn't mean necessarily that you're going to have a massive run in the markets, but what it does mean is that the general bias towards prices will be higher in the short term. But yesterday and then following on its heels today, markets are going to be rallying fairly sharply. We're going to be back to testing the recent highs today, as a matter of fact, on the markets. So pretty amazing turnaround here in just a couple of days. Markets did get oversold. As we talked about yesterday, we pulled off our hedges, added exposure to our portfolios, and so today we're going to just continue to kind of run that pace. Not a lot to do there. But I did want to talk about here for a second, in particular, about the benefit of the outcome of the election. Now, again, we're going to have a huge contest over this, and this is going to be something going on now for the next several weeks as we contest the outcome of the election. But let me explain to you why a particular Biden presidency is really not as bad as you may think it might be. One of the outcomes of this election was the fact that the Senate maintained its majority of GOP control, and the majority of Democrat control in the House narrowed. So this is actually a very good outcome for the markets. And again, if we take a look at the betting predictions right now, the Senate is going to maintain control Republicans will maintain control of the Senate. This is actually a very good outcome for stocks for a couple of reasons. One, we will get more stimulus. And even Mitch McConnell, who is the Speaker of the Senate, or the head of the Senate, came out yesterday saying, look, we're going to pass a stimulus bill before the end of the year. Now, the markets are taking this as this is going to be a huge stimulus bill. It won't be. There's not a lot of appetite in the Senate for a huge stimulus bill, particularly with the size of the debts and the deficits that we currently have going on. But we will get more stimulus. Stimulus will allow the Fed to do more programs. They can take whatever stimulus they get. Let's say they get $1 trillion worth of stimulus. They can leverage that 10 to 1 and basically put new loan programs out into the economy. So more PPP, more Main Street lending program type programs, direct checks to households, probably support for states and municipalities this time around as well. Now, the key ingredient of this is that we will get more stimulus. The Fed will be able to do more. That will lift asset prices. So if you're in the top 10% of the economy that actually has money invested in the markets, it's going to, a divided Congress tends to work out well. And again, as I was saying, gridlock Washington, this was a headline today in the Wall Street Journal, gridlock Washington would force the Fed to do more for the economy. And this is really kind of the fact here, because as we saw yesterday, bond yields took a big plunge here. Deflation is really the key. Why is that? Well, all of a sudden now, because of the split between between a Biden presidency and the Republican-controlled Senate, the idea of higher taxes, that's gone, right? That's good for stocks. The antitrust legislation is much less likely at this point. If there is, it'll be very minor in scope and nature. That's kind of off the table. That's why tech stocks rallied so much yesterday. Stimulus will come in, but it will probably be a lot less than we expect. That's not great for the economy. As we've been talking about, the economy is going to run at a much slower growth rate now, somewhere around 1.5 to 1.75% versus 2.2% previously. We're going to see a slower growth rate in the economy. That's going to require the Fed to do more. And as we get further into debt and we keep increasing the levels of our deficits, we're going to have slower and slower rates of economic prosperity really across the country. So the wealth gap will continue to widen. Those things will continue to get worse. Wage suppression will be an issue, and economic recovery will be slow. So this is going to require the Fed to continue to do more to help elevate the stock market. And I've got an article coming out on this next week talking about the fact that the Fed is doing all they can. Will keep prices elevated in the stock market for the 10% of the people that own those stocks. But for the rest of the economy, there's actually a deflationary impact from Fed actions on the economy. And that's why interest rates simply don't go up. 10-year break-even rate shows this to actually be the case. This is the 10-year inflation expectations. And that's been dropping sharply here over the last few days, in particular heading into the election, as it became a little bit more likely that Joe Biden would win the presidency. And yesterday, 10-year government bond yield took a big plunge. And again, this is because of the idea that we're going to have more deflationary pressures in the economy, not inflationary pressures. So, yes, we'll get a little bit of infrastructure, won't be a massive infrastructure plan. This idea of a complete transition of our economy to green energy away from petroleum-based, not going to happen. So again, more deflationary issues coming from there showing up in bonds. And this also shows, as we discussed, is that if you take a look at the difference between bonds and the S&P 500, we are now kind of an outlier of the normal trend of those relationships, and that's really kind of the bet here that the Federal Reserve will have to come in and do more stimulus for the market. So again, when we go back to really looking at this, a divided Congress has traditionally been, we talked about this before the election when we have our politics over policies discussion. We have an article right now and a video on our website. If you go to our website, realinvestmentadvice.com, simply click politics into the search bar at the top. You'll see our video and our article on policies over politics. And we said, and we showed the same thing, is that historically a split Congress is the best for the stock market. Has nothing to do with the economy, but the stock market tends to do very well in a split Congress. Why? Because more drastic, more extreme programs are not that great, for the economy generally. And so a split Congress eliminates that stuff from happening. In other words, you don't get a lot of policy action. That's good for Wall Street. That's good for the markets. And again, S&P 500, really kind of post-election day tends to be good too. But as we noted yesterday, the first year of a presidential cycle is the weakest of all the cycles. So as we get into next year, into 2021, expect that you're going to have much weaker economic growth, and that will lead to lower stock market returns. The first year of a presidential cycle is about 50-50 between being positive and negative, and it's also one of the lower average return years out of all 4 years of the cycle. So again, as we really discuss this, is that there's a lot of angst about potentially a change in the presidency, but it's really not as bad as you think because of this idea that you still have a Republican-controlled Congress, a narrow margin in the House, which is going to limit a lot of the more extreme policy actions that you might have had previously. Now, as we're going to talk about with Michael Lebowitz, who's a CFA, in just a second, we'll get a little bit more about this, talking about policy, talking about what the potential outcomes will be, what the Fed is going to do, what this all means for the economy ultimately, and of course what this means for your money, because that's what we're here to talk about, is your money. So don't go away. I'm your host, Lance Roberts, for The Real Investment Show. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Everybody get up!
Let's try that again. And welcome back to the show this morning. I'm your host, Lance Roberts. It is The Real Investment Show. And, of course, this morning, Michael Lebowitz, CFA, joining us because it is the second best day of the week when Mike joins us because it's Thursday. Has nothing to do with Mike. Has nothing to do with Mike joining us. It's just Thursday.
Right.
So, Mike, good morning.
The weekend is near us.
Exactly. Mike, how are you this morning? So a couple of things. I was just spending a few minutes kind of going through some statistics of, there's a lot of angst about the outcome of the election. First of all, we don't even know what the outcome of the election is for sure yet. There's going to be lots of legal challenges here. There was an interesting headline out this morning. There's a United States Postal Service whistleblower out of Michigan saying that there was a lot of backdated postmarks for ballots that were put through. We saw, video in Texas from Project Veritas of potential ballot fraud. I mean, so this is all going to go to court now and going to be tied up for weeks about who the presidency is. But Lance,
real quick.
Yeah.
It's going to go to court. I think it's going to go to court for both sides because the Biden team understands that if a state flips, they could go from potentially winning the election to losing.
Right.
So they're going to challenge some of the results in some of the states that they barely lost.
Right.
So it may not just be these states they're talking about on TV, the Pennsylvanias, the Arizonas. This could be
more widespread.
5, 6, 7 states.
Yeah, and that's a great point. But I was going through some stats this morning at the opening of the show going, look, even if we wind up with the Biden presidency, it's not necessarily such a bad thing. I know everybody's kind of, everybody wants, their guy to win, and I got that. I'm a fiscal conservative, which has nothing to do with Republicans or Democrats. That's two totally different things. But, I know a lot of people are kind of angst about this, but, it may not be such a bad thing because, again, the GOP maintained control of the Senate. They narrowed the majority of Democrat control in the House, which is going to make it much more difficult for some of the more extreme policies that were, kind of on the platform, the Biden platform, from being implemented. Markets obviously liked that yesterday. Huge rally in the markets yesterday. Big drop in bond yields, money flowing into bonds, deflationary pressures, kind of an expectation here. Because we will get stimulus. Even Mitch McConnell yesterday saying, hey, stimulus first priority before the end of the year. Could be a lot less. It will likely not be a massive $3 trillion bill. It could be something like half a trillion to $1 trillion. Not nearly enough to sustain the economy at this point of the recovery cycle. But again, markets seem to like all this at the moment anyway. Your thoughts?
So what's interesting is, and I agree, if you take a glance at the front page of the business section, markets loved what happened yesterday. But the breadth was very interesting. Mm-hmm. So the largest stocks, which tend to be mainly the tech stocks, right, did very well because the odds of regulation have now decreased against them. Healthcare, which are some very large stocks, also did very well because there was not a Democratic sweep, and which meant new healthcare, which would probably be harmful to them.
Right.
So they rallied after struggling. But, sectors like industrials, materials, transports struggled yesterday. But the thing is, when you look at the way these indexes are composed, those are very small pieces. Mm-hmm. So materials and industrials can be down multiple percent each and barely affect the market. Whereas if Apple's up 20%, it can offset one of those sectors or two of those sectors all by itself.
Right.
So,
but wasn't a lot of that decline, though, in industrials and materials and transports? Those have been running up prior to the election because they were looking for a blue wave, huge infrastructure packages. Likely not going to be the case now. With a divided Congress, because again, despite what people think, there is still a contingent of the GOP that is mindful of the size of the debts and deficits that we're running.
Right. I think they're going to be a lot more mindful now.
Yeah.
Because it's politically more advantageous. But if you just look at a graph of the S&P, we're still below the highs of. Not the late September highs, but the highs after that.
Right.
So, we haven't fully gone back to where we were. And I think a lot of what we're seeing looks like a huge rally, but a lot of it is just rotation.
Right.
Right. And it's the rotation because of the way these indices are composed looks gigantic.
Right. Well, it is. And the market's going to be up another 2% today. Yeah.
It is.
Yeah.
But the market is sending all kinds of signals, and you said this earlier, and I think bonds are telling us something very important, right? Very deflationary pressure.
Right.
The 10-year bond was down about 10 basis points yesterday. It's going to be down another, I don't know, I'm guessing 4 or 5 today.
Right.
It's telling you that there is no more inflation because there's not going to be a blue sweep, meaning massive stimulus. And like you said, infrastructure and stimulus, and more of the CARES Act first, and then stimulus infrastructure second. But now we have to deal with a mixed Congress again, and it's going to be much harder to pass stuff. And this recovery is brought to you by the federal government. Well, it's not brought to you by Jane and Joe Consumer.
Well, that's actually an interesting point because, this is also kind of another problem for the Fed. One thing that, one of the big catalysts for the recovery from the March lows as well as the market recovery from the March lows has been, the Federal Reserve. And while the Federal Reserve everybody's starting to now look back to the Fed saying, okay, hey guys, you're going to need to do more here. The problem for the Fed is that they need a big stimulus package in order to have the debt to monetize. But now that big package may not be coming. So the Fed may now actually be in a corner as well, which is going to lead me up to the topic that I want to talk about in the next segment, which is really whoever won this election might have been the unlucky one. And I want to talk about that, the reasoning behind that in a second. But I wanted to get your views on the Fed here because, again, as you correctly stated, this recovery brought to you by the Federal Reserve. Thank you, Jerome Powell. Are they going to be limited potentially in some of the things that they can do to help support markets and the economy?
Yeah, they are, and they already are. Right? The Fed knows that they really can't help the economy all that much. Right. We've talked about this many times. Lowering interest rates again and again, the marginal benefit declines. Right? So they know, and doing QE does nothing more than help lower interest rates on slightly and goose the markets. And it's been proven now for 40 years that goosing the markets has very little economic effect.
Right.
The Fed knows this. They're not dumb. And there was a Bill Dudley article, and actually at the break, I'll dig it up and I'll read a couple key lines when we come back. There was a Bill Dudley article who used to be the ex-president of New York Fed up until a couple of years ago, who basically said the Fed is out of power. They need fiscal stimulus. And if you go back and look at every speech by Powell over the last 2 months, he's begging for more stimulus. Mm-hmm. Right. And we got a Fed meeting today. He's going to beg for more stimulus.
Yeah.
It's going to be, I think they're even going to put it in their statement. And then during a press conference, I guarantee you, he'll mention it 2 or 3 different times that we're limited, we're handcuffed. We need the fine people of Congress and a president to give us stimulus. And that's what this country needs. And he's kind of right.
Yeah. And let me, and I just want to make sure everybody understands why there's a connection here. The Federal Reserve, and this is one of the fallacies a bit about when people talk about the Federal Reserve, is that, they can just print money, at their leisure. And that's not really the case. What they can do is they can make loans, and they can provide loans, and they can provide excess reserves to banks. But they need the debt from the Treasury. And this is now why there's a linkage between the Treasury and the Fed. They need that debt so they can buy that debt. So, okay, so first of all, let me explain the loop here real fast for everyone. The Federal Reserve cannot do anything independently. They need the Treasury to issue the debt. The Treasury issues debt to fund the deficit spending of the government. That debt, those Treasury bonds, are then bought by the major Wall Street banks. There's 20 primary dealer banks in the world that buy the Treasuries directly from the Treasury. The Federal Reserve then buys those bonds almost immediately from those banks, crediting their excess reserve accounts. This provides a lot of liquidity into the banks. The banks are supposed to lend this out to individuals, right? For your mortgage, your auto loan, for your business startup. Unfortunately, that never happens. They actually just invest it into the stock market. And that's why stock markets go up so dramatically under this. But, that's the problem for the Fed here, is that in order for them to do anything, they've got to have more debt from the Treasury.
Here's the one thing that, if you could just remember this, all money is lent into existence. So the birth of money comes when it is lent to someone. So basically the Fed is putting these reserves on the banks, and that's all the banks need to lend money. But the banks aren't lending money, ergo the banks are not creating money. So there is no money creation. In fact, there's a bunch of surveys out there showing that lending conditions are really tight. And they're just not lending. They're concerned. There's no profit margin. Why should they?
Well, first of all, I'm going to loan money to American Joe, who is out of work or working at a very reduced wage right now, for 30 years on a mortgage at 2.5% inflation. I don't even make at 2.5%. I'm not covering my cost plus inflation if I'm a bank. Right. So why would I loan it, right? And that's why if you take a look, but Lance, housing prices are soaring. Housing prices are soaring because there's very low inventory at the moment, because the number of qualified buyers have been shrunk dramatically. If you take a look, to get a loan, you need a 720 credit score, a job.
And 20% down.
And 20% down. That's the only way. And this is why you now have over 50% of millennials now living at home with parents, because they got nowhere to go. But I'm going to tell you when we come back. I mentioned this a second ago. Mike and I are going to tell you when we come back about whoever won this election was actually the unlucky one. And we'll tell you why that is when we come back from the break. Don't go away.
Of the world and our Western civilization. The sun may rise in the east, at least it sets in a final location. It's understood that Hollywood sells Californication.
Yeah.
Listen anyplace, anytime at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And welcome back to Just More. 6:33 on the Real Investment Show. I'm your host, Lance Roberts. Just for the break, we talked about the fact, two things, and I want to throw this to Mike here real quick about a comment from Bill Dudley from the Federal Reserve, but also we wanted to talk about why whoever won this election, or whoever actually wins this election, I shouldn't say, because we don't know for sure yet, but whoever wins this election might actually be the unlucky one. We'll talk about exactly why that's the case here in a second. But Mike, you had this quote from Bill Dudley you wanted to talk about.
Yeah, so in the article, which actually just got published minutes ago, hot off the press, Tales of Cobras, Windows, and Economic Promise. Sounds more like a Halloween type story, but
right?
anyway.
Realinvestmentadvice.com. That's where you'll find it.
Well, we should have done it last week, not this week.
Yeah,
I put in there a Bill Dudley quote. He wrote an op-ed for the Wall Street Journal about a week ago, maybe 2 weeks ago. And there's a couple paragraphs I just want to read verbatim. And the article was called "The Federal Reserve is Really Running Out of Firepower." So this is quote from Bill Dudley. Moreover, the stimulus provided by lower interest rates inevitably wears off. Cutting interest rates boost the economy by I need my glasses here, by bringing future activity into the present. So let me read that again. Cutting interest rates boost the economy by bringing future activity into the present. Easy money encourages people to buy houses and appliances now rather than later. But when the future arrives, that activity is missing. The only way to keep things going is to lower interest rates further until, that is, they hit their lower bound, which in the U.S. is 0. Second paragraph, when interest rates stay too low for long enough, the policy can even become counterproductive. In the U.S., monetary stimulus has already pushed bond and stock prices to such high levels that future returns will necessarily be lower. No central bank wants to admit that it's out of firepower. Unfortunately, the U.S. Federal Reserve is very near that point. And that very much sums up what we were talking about. That we took our stimulus money and we took our lower rates and we bought cars today instead of buying them in, let's say, April of next year.
Right.
So the economy gets a boost today. April of next year, we don't need to buy a car. We have a brand new car.
Well, and this is kind of exactly my point about why whoever wins this election is likely to be the unlucky winner, right? What presidents want is they want to be successful in their 4 years. And this has been really kind of one of the, for Republicans anyway, this has really kind of been one of the plagues, and not just recently, but kind of over the centuries, over the last century, sorry, not centuries, but over the last century, it's kind of really been a plague of the Republicans, is that Democrats have been very fortunate to catch the swings of cycles coming out of a recessionary a function of the economy. They have 4 to 8 years of really good economic recovery and growth, and then the Republican wins the election just in time to inherit the next recession. A good example of this was George Bush, right? 8 years of a fantastic economy under Bill Clinton. He really didn't do a whole lot because he was catching the tailwinds of Reaganomics that started back in the early 80s. Caught that great tailwind for the economy and innovation and the dot-com bubble. George Bush wins the election. Yay. Great. Just in time for Enron, WorldCom, 9/11, the financial crisis. I mean, the guy never had a chance. I mean, honestly. Then we get President Obama. Inherited basically a blown out economy. There was, if President Obama had just gone into office and then shuttered himself in for 8 years, we would have had an economic recovery. We would have had a stock market recovery. It wouldn't have been nearly as big, but he inherited the perfect set of tailwinds to have a good economic balance. Donald Trump walks into a very late stage economy. We wind up with the sell-off in 2018. We wind up with, the economic recession now. And all we needed was a trigger. Yes, it was the pandemic. We can point to the pandemic and say, oh, that was the trigger. But that wasn't the cause of the recession. The ingredients for the recession was already there. We had inverted yield curves last year. Everything was telling us we were headed for an economic slowdown and just needed a catalyst. That was the pandemic. So, for whoever wins this election, the next 4 years, to your point and Bill Dudley's point, we got super high valuations, which means probably lower stock market returns, increased volatility. Interest rates are at 0. And the problem with stimulus is great. We did stimulus when you needed it back in March. You got a bump from that. But anything you do stimulus-wise now will be less than what we did previously. The economy has already recovered somewhat, which means it has less impact on the economy, you get lower rates of economic growth from that. And more importantly, you're now trapped because you do stimulus this year, then you're going to have to do it next year and the year after and the year after that. You're now trapped in this never-ending loop of stimulus because you got to keep pulling forward that future economic growth.
Right, and Bill Dudley's telling us, me and you are telling us all the time, rates can't really go any lower, right? Half the rates are below, are below 0.5%, and then even mortgage rates are below 3% now. Mm-hmm. I mean, it's insane. So who are you incenting to buy a house or to refi their mortgage when mortgage rates go from 3 to 2.5%?
Right.
Yeah,
Well,
very, very little.
Well, this is one. We just wrote an article recently. You hear a lot of stories on in the news about the shortage of housing. Right, we've got this massive shortage in housing. We don't, but what we have is a lot of people who aren't moving. Right, the what happens in housing only happens on the fringes, and that's when people are buying or selling a house. But with mortgage rates very low, and I'm out of a job, I can't qualify to move. If I sell my house, where am I going to move to, right? I can't buy a new house because I can't qualify for it because I don't have a job. But even if I do move, where the prices have run up in areas, it really doesn't make sense. My mortgage payment's going to go up. And this is the big risk for, people keep calling for the end of the house, the end of the bond bull market, right? Interest rates have to go up because they're low. That's the worst thing that could ever happen. If interest rates go up, now all of a sudden, everybody that has a 3% mortgage, they're never moving again, because when they move, their mortgage payment's going to be drastically higher from higher rates. And so people are going to say, I can't move, right? I'm stuck.
That's the Fed trap.
Yep.
They're trapped into lowering rates more and more, but the problem is they can't lower them anymore. And yes, they can. They can go negative, right?
Right.
But they've watched European and Japanese banks get destroyed when you go to negative rates. And yesterday, what was the big negative move yesterday? Which sector got killed? Which banks in particular got killed?
J.P. Morgan, Bank of America, all of our favorite commie socialist bankers.
They got hurt.
Just what they deserved.
They got hurt.
Bunch of mafia. Sorry.
They got hurt, but who got killed? It was the small regional banks.
Yeah.
Because the small regional banks don't have the Fed to help them play around in markets for that extra income. They are almost solely dependent on margin. Right?
Exactly.
And that's what it's telling you, that the lower they bring down rates, the more they're going to destroy the banking market. And then, so where does that leave us? The Fed becomes the bank that we all go to? I'm going to go to the Fed and get a car loan?
Yeah. Well, I know we're getting there. And it's interesting, though, when you think about this, and again, let's, going back to this whole premise about whoever won is actually the unlucky one. I'm watching Fox News right now. We've in our studio, if you haven't seen our live feed, we've got CNN on one channel, we got Fox News, CNBC. So we can monitor kind of what's going on in the news as we do the show. And there's just a very interesting snapshot of a protest march on television, saying capitalism is killing us. We need a socialist alternative. No, capitalism is not killing you. It's what we're doing to capitalism that is killing you. By continuing to do these bailouts and by continuing to keep zombie companies alive, that erodes the opportunity for innovation, that erodes the opportunity for opportunity. Capitalism is about providing opportunity, and what the Federal Reserve has been doing and what we have been fostering from our political system has been the erosion of the capitalistic process, which would benefit everybody more than what we've got going on now. And the last thing you want is a socialist outcome. But this is what we're all demanding, right? We all want free money. We want the government to pay for everything. But socialism in every country is the worst possible outcome for the economy.
Right. The sad part is I think what people are saying is we want what the corporations have already gotten.
Yeah.
Right. That's the problem. The precedent has been set. And now everyone wants what's theirs, and it's a big problem, and it's hurting. Socialism is not the most efficient form of government because it takes away incentives. Mm-hmm. And the more we move in, we are socialist in a lot of ways at this point, right? I mean, we're not a capitalist society anymore. And I think the corporations benefit more than people, although it's becoming everyone's benefiting. Okay. And if you want to truly help the people, help the poorest of people, not just in this country but around the world, bring back capitalism. Right. Let companies go under. Let people default on their student loans. Let them default on mortgages. Don't let them sit in in forbearance for 3 years. Right. Let corporations fail.
And again, this is the process of what makes capitalism work well. We don't want that because nobody wants to take on the pain, right? We don't want the pain. So we do stimulus, and stimulus is like life support for a patient. And it's fine, but as soon as you remove the life support, the patient's going to die. And in some and that's a horrible analogy, but it's the point. We're in capitalism is on life support. at this point. And people are demanding socialism because it seems to be the non-painful alternative. And it is a non-painful alternative short term, but it leads to less economic prosperity. So everything you're voting for to want more socialism, more bailouts, more of this, more of that, it's great for now. It's going to make you feel good for now. But your opportunity is less and less and less. And this is why we have this massive wealth gap. And it also proves, to Mike's point, the corporations have been getting socialism now for the last really decade. And the hope has been it would trickle down to the rest of the economy. Trickle down economics has never worked, ever. And this proves it, but we still keep clinging on the idea that maybe someday if we keep doing it, it will. Be right back on The Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
The show this morning. I'm Rose Lance Roberts, Michael Lebowitz, CFA, joining me. So I wanted to finish up on our conversation about why whoever the next president is likely to be the unlucky one. And let me just boil this down into a real simple formula here. First of all, you've got very high valuations in the stock market, really kind of across the board, right? So ultimately, there is now a negative correlation between, we wrote about this in last weekend's newsletter, I believe. There's a negative correlation between the stock market and the economy. That's the first one that's existed ever in the history of the United States. Why is that important? Is because the stock market, right? Apple, Microsoft, Google, Abbott Labs, UNH, all these companies, they derive their earnings from where? The consumer. Where does the consumer live? They live in the economy. So there is a high correlation historically between the returns of the stock market and the growth of the economy. Makes perfect sense because the stock market is a reflection of the economy. The economy is going to be growing roughly 1.5 to 1.75% going forward here over the next few years. So again, when you start looking at the detachment from the market, from the economy, that will be a reconnect. So very likely in the next 4 years, we're going to have a fairly major market correction, particularly if Mike and I are right, talking about the Fed being limited in their options. Markets are going to run into trouble. That's not going to bode well for the current president. Very likely, we're going to have a secondary recession somewhere within the next 4 years because of the impact of what's happening underneath the economy, low wage growth, this idea of wanting more and more stimulus that will ultimately fail, lead to weaker economic growth. So pretty much, and I'm going to let Mike jump in with his few points here as well. But from kind of the view looking forward of where we are economically, where we are financially, where we are market-wise, the outcome. And again, it doesn't really matter who's the guy sitting in the White House. He's the guy that gets blamed for it. Right. So, you're walking into a situation to where the outcome of anything you do for the next 4 years will likely not be good. And you're going to get blamed for something that was already built, this excess that's been the excess debt, the excess leverage, the excess monetary interventions, all that's been building up for over a decade. And when that unwinds, you'll be the guy who gets blamed for it. Mike? Right.
The economic engine has been sputtering for the last 3 or 4 years, right? Mm-hmm. Even 2019, everyone fails to forget the Fed lowered interest rates in the fall of 2019 and started doing more QE.
Right.
During a quote unquote good economy. Right. The economic growth rates, if you look at the economic growth rates of the expansions after recessions, they are continually less than that of before the prior recession.
Right.
So what that's telling you is that something is happening during a recession that's that's softening the recession but costing us in the future. Now you look at what happened with COVID, and we had a flash crash, an economic flash crash of, numbers, data that we haven't seen since the Great Depression, in some cases even worse than that. And the amount of stimulus doubled that, which was done only 10 years ago. So we pulled forward a tremendous amount of consumption. We've at a cost of a tremendous amount of debt. The debt now has to be paid, and our needs to buy stuff in the future are less. And given that our car was sputtering already and stalling out at times, the future just does not look good. And the Fed's telling you in no uncertain words that there's not much more they can do. And all they can do is keep interest rates near zero, so the Treasury just can keep buying economic recovery. Right. But, the fact is we didn't get a blue sweep. We didn't get a red sweep. So no one has full control. And with a split Congress and a very contentious atmosphere, this is going to be very problematic there'll be stimulus, but massive stimulus like that we thought we could see with a blue sweep isn't going to happen. Right. And every day it doesn't happen, economic growth is very suspect. Yeah. And this whole pull forward concept, we do it every year with the whole holiday season, right? What's Black Friday? Black Friday is the day that traditionally retailers become profitable for the year. So if you just look at kind of retail sales over the course of the year, they trend over time, they trend higher because of population is growing and all sorts of things, but they bulge higher during the last 3 months of the year, and they go lower during the first few months of the year. And that's pulling forward. You're pulling forward. You're giving everyone these gifts and getting gifts, but then you don't need that stuff. You don't need the new socks and new underwear and all the good things we get.
I wait all year long for new socks and new underwear. So let's let's just keep this in perspective, will you?
Right, but no one's buying underwear in January or February.
Know, right?
And that's what's going on now. We're pulling forward. This is our Christmas. This recovery is Christmas, and we got the next president has January and February and March. That's their term. Good luck.
And honestly, this is something that I've talked about for years on the show, is that I've been trying to convince my family to accept, paper certificates on Christmas Day of the gifts they're going to get in January when everything goes on sale. And, really, if we could think about running our economy this way, is like saying, look, we're going to have some really great sales on stuff in the next 3, 4, 5, 6, 7 months or a year. And we're going to try to navigate between here and there and put the economy into a position to where we can get this stuff on sale and really put ourselves in a position to allow for a better recovery and be more fiscally responsible long term. Unfortunately, our government's trapped in the same mentality as I've got to have my gift on Christmas, right? My family will never go for the I'll get it after Christmas certificate, right? They want it on Christmas. But that's, this is the on-demand economy that we've created, right? Go into debt. It's no big deal, right? Just go into more and more debt. You can live your life today. YOLO, you only live once, right? So got to have it today, despite the fact of the fiscal irresponsibility has now led the vast majority of the population, 80% of Americans have less than 1 month of savings saved up. And we saw this during the pandemic. They ran out of money overnight. They got to have stimulus just to pay bills. And, we've fostered for the last 40 years, we've fostered this fiscal irresponsibility in the country, and now we're paying the price for it.
Right. And again, this has nothing to do with which party's in control. Right. I mean, this is much more of a problem today than it was in 2019 because we had another, it's not really a Christmas, but we decided as a country some time ago that recession should be outlawed, that we're going to do everything we can do to fight recessions. Well, there's a huge cost to that, and that cost is always in the future. And like everything else, as an economic country, as the economy, all we care about is today, is about expediency, about we can't have a recession. Who cares if we pay for it in the future or our kids pay for it in the future? But you keep doing that, and you run out of gifts to give, and that's where we're at.
Yeah, no, we keep hoping that the next generation will pick up the tab, and that keeps passing on, right?
And here's the other thing, which Bill Dudley actually alludes to, right? When rates are so low, what tends to happen is investors speculate instead of investing into productive ventures.
Right.
Productive ventures help pay the bills in the future. They not only pay off their debt, but they produce income and they grow. And it's not just the person that invested in it, but the people that work for that venture. And that's what helps grow society. But so many corporations too, they're buying back stock instead of investing, right? Yeah. They're all speculating. Speculating gets us nowhere as a country. It actually harms us.
Real quick here for the top of the hour, we're almost done here. I just wanted to ask your opinion. In 2016, in the Trump election, the pollsters got the outcome of the election so wrong. And this in 2020, all the pollsters says, "Oh, we amended our formulas. We adjusted our strategy. Blah blah blah," and they were even worse on their predictions this year than they were in 2016. Is the pollster business going to be dead now? I mean, is anybody actually going to listen to people like Nate Silver at 538 anymore?
So yesterday I put out my, on Twitter, if you follow me on Twitter, I put out my investment outlook for the next 4 years. Mm-hmm. And I have two big trades,
right?
Short pollsters and long coin tosses. Because I think a lot of pollsters are biased, and I think that a lot of things are changing in the way we vote and how we vote, and it's also very hard to predict. And they seem set on telling us what the outcome is, and they've been wrong now. In many cases, just grossly wrong.
Well, one thing that I thought about is that, there's been such a backlash against, if you say, hey, I'm voting for President Trump, I mean, the backlash has been terrible on social media, Facebook. I mean, we have such a deep division between the left and the right, more so than at any other point in history of the country. And I know, and people that were voting for Biden, they were kind of in a safe haven, right, from the media. If they said, "Oh, I voted for Biden," they didn't get any backlash at all. But if you say you're voting for Trump, you got a lot of backlash from the media and from the other. I mean, is it possible these pollsters were going out and interviewing people and people are going, "Yeah, I'm voting for Biden," when they were really voting for President Trump? They just didn't want the backlash.
Oh, that's probably going on too. There's all kinds of, I think there's all kinds of things going on, and they're really hard to predict, but they're trying to be so definitive, plus and minus margin of 2%.
Yeah.
That's ridiculous given what we've seen the last, and there is a bias. And, it's all the media outlets, conservative and liberal. They're all biased, which they start off, and the bias may not even show, but it shows in the way they collect the data and how they collect it.
So next year we will be doing coin tosses on the show in the next election to predict the outcome. So anyway, that wraps up the show for today. Michael Lebowitz, CFA, thank you so much. Be sure to go by our website. His latest article is out right now on the website, talking about the Cobra effect, talking specifically about Bill Dudley and the impact, on the economy. It's on the website now, realinvestmentadvice.com. While you're there, get our latest policy over politics video webinar as well. Just simply type in politics in our search banner. It'll be there for you. Realinvestmentadvice.com. Have a great day. Send us your questions and comments. We'll see you tomorrow.
If I had a little money, it's a rich man's world.